The Wall Street Journal just confirmed it. COMEX silver just had the second worst day on record. 48 hours ago, silver was trading at $121. Right now, $85. That's a $36 collapse. And traders are asking, is $70 per ounce next? Here's what the data is showing. They just detonated the silver market. $121 to $85 in 48 hours. A 30% annihilation that ranks as the second worst trading day in recorded history. Only 1921 was worse. And that was 103 years ago. The red candles are stacking, the margin calls are hitting, leveraged traders are getting massacred. The financial media is declaring the precious metals bull market dead. Technical analysts are drawing arrows pointing straight down to $70, $60, maybe even $50. But here's what they're not telling you. While COMEX is burning, while Western traders are panic selling, while the paper price is collapsing, something completely different is happening in the physical market. Something that suggests this crash isn't the end, it's the beginning. If you want the raw truth instead of mainstream fear porn, hit that like button. Share this with someone who needs to see reality, and let's break down what's really happening. I'm Asian Guy, and this is the crash analysis Wall Street doesn't want you to hear. Let's start with the carnage. Silver opened the week above $121. By the time the dust settled, we were at $85. That's a $36 drop in 48 hours, a 29.75% destruction of value. The second worst trading session since records began in the early 1900s. Gold wasn't spared. Down 13.6%, crashing below $4,900. Platinum obliterated 27.25%. Palladium crushed 21.5%. Across the entire precious metals complex, over $7 trillion in market capitalization evaporated. Not over weeks, not over months, in 2 days. To put that $7 trillion loss in perspective, that's larger than the entire economy of India. It's double the GDP of Japan. It's 2.5 times the United Kingdom's entire annual economic output. And when you add the simultaneous stock market crash, the combined wealth destruction exceeds $10 trillion. The technical damage is catastrophic. We broke through $110 support like it was paper. The $100 psychological level didn't even slow the bleeding. $95 support that held for weeks? Gone. $90 floor that everyone said was rock solid? Shattered. We're now at $85, and the bears are screaming that $70 is next. The red candle of death. That's what they're calling it. The chart pattern that signals complete capitulation. The formation that marks the end of bull markets. Retail investors are liquidated. Hedge funds blown out. Trading desks are in chaos. Margin clerks working overtime, processing forced liquidations. Every technical indicator is screaming sell. The RSI crashed into oversold territory and kept going. The MACD crossed bearish with violent momentum. Moving averages that held as support for months were sliced through like they didn't exist. The 50-day, the 100-day, the 200-day, all broken in a single session. But here's where the story stops making sense. Because while all this carnage was unfolding on COMEX, while Western traders were puking positions and algorithms were executing sell orders, the physical market was doing something completely different. Shanghai spot silver closed at $122. COMEX closed at $85. That's a $37 premium, a 43.5% markup over the paper price. Let that sink in for a moment. Physical silver in China is trading 43% higher than paper silver in New York after a 30% crash. In every other market crash in history, premiums compress, physical sellers panic, they rush to liquidate inventory. Premiums fall to zero or go negative as desperate sellers undercut each other. But not this time. The Shanghai premium didn't compress. It didn't normalize. It didn't shrink. If anything, it widened. When COMEX was at $121, the premium was around $10 to $15. Now COMEX is at $85, and the premium is $37. The lower the paper price goes, the wider the spread becomes. That's not how markets work. Unless something very strange is happening beneath the surface. And it's not just Shanghai. Look at the delivery data from COMEX itself. On first notice day for February contracts, 9.4 million ounces of silver delivery notices were issued. That's 1,881 contracts demanding physical metal. And this was before the Friday crash accelerated. Wells Fargo issued 701 delivery notices. JP Morgan issued 395 and stopped 487 more. Macquarie issued 459 and stopped 533. These are the biggest banks in the world, and they're frantically moving metal around, issuing notices, stopping notices, scrambling to manage physical exposure. Ask yourself this question. If silver fundamentals were truly broken, if this crash reflected real supply-demand weakness, why would delivery demand be surging? Why would the banks be fighting over physical metal? Why would Shanghai buyers pay 43% more than New York traders? Here's what actually happened. And once you understand this, the entire crash makes perfect sense. The physical silver market was tightening into a dangerous squeeze. COMEX registered inventories have been draining for months. Shanghai vaults are being depleted at a rate of 5% to 6% per day. Industrial demand is running at record levels, while mine production is flat or declining. The system was approaching a breaking point, a delivery crisis that would expose the fact that there's far more paper silver being traded than physical silver available to deliver. And when that happens, when the COMEX can't deliver against contracts, the entire pricing mechanism collapses. The paper casino gets exposed as fraud. So they hit the panic button, coordinated short selling across the futures markets, massive sell orders executed in thin trading conditions to maximize downward pressure. Algorithmic selling triggered to cascade stops and liquidate leveraged positions. This wasn't organic price discovery. This was a controlled demolition designed to achieve specific objectives. Objective 1, shake out weak hands. Retail traders with tight stops got blown out. Objective 2, force margin calls and liquidations. Anyone trading on leverage got destroyed, forced to sell regardless of conviction. Objective 3, reset positioning before the physical squeeze could accelerate into a systemic crisis that breaks the paper pricing mechanism. Think about the timing. Record delivery demand before the crash. Shanghai premium already elevated and widening. COMEX inventories draining. Then boom, the second worst trading day in history. Retail wiped out. Leveraged funds liquidated. And after all that violence, the Shanghai premium is not only intact, it's larger. The physical buyers didn't panic. They didn't sell. They kept buying. At $122 in Shanghai, while COMEX crashed to $85. That divergence is the smoking gun. That's proof this was paper manipulation, not fundamental weakness. Now, let's talk about the catalyst that could turn this crash into rocket fuel. Poly market odds for a U.S. government shutdown by January 31st just hit 85%. That's tomorrow. And if you think a shutdown is just political theater with no economic impact, you need to look at the 2025 data. 43-day shutdown. 2.8% GDP contraction. $34 billion in direct economic damage. 670,000 federal workers furloughed without paychecks. Government contracts frozen, approvals delayed, economic data releases suspended, federal agencies operating on skeleton crews. That's real economic disruption. And here's what happens to markets during shutdowns. It follows a predictable pattern. Phase 1, risk-off liquidation. Everything sells as traders flee to cash. Stocks down, bonds bid, precious metals initially dumped as margin calls force indiscriminate selling. Phase 2, safe haven rally. As the shutdown drags on, fear spikes, the Fed signals accommodation, and capital flows into gold and silver as protection against government dysfunction and currency debasement. We just witnessed Phase 1, the 30% crash, the liquidation, the panic selling. But Phase 2 is coming, and when it hits, with physical demand this strong, with premiums this wide, with inventories this tight, the snapback could be historic. Democrats are using the Minneapolis Border Patrol shooting to block DHS funding on the Senate floor. If DHS funding fails, you get a partial shutdown that could spiral into a full closure. Markets aren't pricing this risk. The VIX is elevated, but not screaming panic. Credit spreads haven't blown out. The bond market is relatively calm. But precious metals are the canary in the coal mine. They're already reacting. The crash we just saw might not be selling the fundamentals. It might be front-running the shutdown chaos that's about to hit. Let me lay out the bear case honestly, because I'm not here to sell hopium. The technical damage is severe. We went from $121 to $85 in 48 hours. That's not a healthy correction. That's a breakdown. And breakdowns often lead to further selling before a bottom forms. The next support level below $85 is around $75 to $78. If that breaks, there's not much holding us up until $70, and if $70 fails, we could see a full retest of the lows from the previous consolidation around $60 to $65. The momentum is bearish, the trend is broken. The moving averages are all pointing down. If you're a swing trader who got long at $110 thinking that was support, you're down 23%. If you were leveraged, you're either liquidated or close to it. If you have tight risk management, you got stopped out and you're sitting on the sidelines watching this unfold. The pain is real. The losses are real. And here's the other risk. If the government shutdown actually happens and market panic accelerates, we could see another wave of forced liquidations. Hedge funds de-risking, pension funds reducing exposure, algorithmic selling programs triggering on technical breakdowns. The initial reaction to crisis is always liquidation, not safe haven buying. The paper market can stay irrational and manipulated far longer than most traders can stay solvent. We could grind lower for weeks or even months before the physical reality reasserts itself. There's no guarantee that $85 is the bottom. no magical support level that can't be violated. If you're trading on margin, this environment is a death trap. Even if you're right about the long-term thesis, the short-term volatility can wipe you out before the turn comes. And let's be brutally honest, most retail traders don't have the capital, the conviction, or the risk tolerance to survive a move from $121 to $70. But here's why the bearish case for paper doesn't change the bullish case for physical. The Shanghai premium of $30 after a 30% crash is historically unprecedented. In the 2008 financial crisis, premiums compressed to near zero as physical sellers panicked. In the 2020 COVID crash, premiums spiked temporarily but normalized within weeks. This time, the premium is not only holding, it's expanding. COMEX dropped from $120 to $85, a $36 decline. Shanghai premium expanded from roughly $10 to $37, a $27 increase. The lower the paper price goes, the wider the physical premium becomes. That's not weakness. That's proof the paper price is detached from physical reality. 9.4 million ounces of delivery demand on first notice day. That's not speculators rolling contracts. That's physical buyers demanding metal. And this was before the crash. Now that paper is cheaper, physical demand is likely even stronger. The banks issuing and stopping hundreds of contracts each. Wells Fargo, JP Morgan, Macquarie. They're not doing that because silver is oversupplied and worthless. They're doing it because physical is tight and they need to manage exposure. The fundamentals haven't changed. Global industrial demand for silver in 2025 is estimated above 580 million ounces by the Silver Institute. Solar installations alone are consuming over 320 million ounces annually. Electric vehicles, 5G infrastructure, AI data centers, all require silver. That demand isn't going away because COMEX crashed the paper price. Meanwhile, mine supply is flat to declining. Primary silver mine production peaked years ago. The decline in base metal mining, copper, zinc, lead, means less byproduct silver. Above-ground inventories are being drawn down. COMEX registered silver has been falling for months. SHFE vaults in Shanghai are being depleted 5% to 6% per day. The structural deficit is real. The Silver Institute projects deficits continuing through the end of the decade. You can't manipulate supply and demand forever. Eventually, physical reality overrides paper manipulation. And when that happens, the snapback is violent. Here's what everyone forgets. Silver has done this before. In 2008, silver crashed from $21 to $8, a 62% decline in a matter of weeks. Everyone said the bull market was over. The technical analysts drew charts showing $5 or lower. The bears declared victory. What happened next? Silver bottomed at $8 in November 2008. By April 2011, it hit $49. That's a 512% gain in less than 3 years. The crash wasn't the end, it was the setup. In 2020, silver crashed from $18 to $12 during the COVID panic, a 33% drop in a few weeks. Bears said it was going to single digits. Traders capitulated. Panic was everywhere. What happened? Silver bottomed at $12 in March 2020. By August 2021, it hit $30. A 150% gain in 17 months. The pattern repeats. Manipulated crashes create asymmetric setups. The paper market gets destroyed. Weak hands capitulate. Leveraged positions get liquidated. And then, quietly, physical buyers accumulate. The fundamentals reassert, the premium widens, the inventories drain, and the next leg up is explosive. So here's what we have. We just witnessed the second worst trading day in silver's history, $121 to $85 in 48 hours. Technical carnage, retail liquidated, bears declaring victory and targeting $70 next. But we also have a 43% Shanghai premium that's holding and expanding. We have record delivery demand of 9.4 million ounces before the crash. We have banks scrambling for physical metal. We have structural supply deficits projected through the decade. We have industrial demand at record levels and growing. We have an 85% probability of government shutdown tomorrow that could force Fed easing and spike safe haven flows. We have COMEX margin hikes to $52,000 per contract, a sign of system stress, not strength. We have 9 consecutive months of gains before this crash, proving the underlying trend is still bullish. And we have historical precedent. Every major silver crash in the last 20 years set up the next explosive rally. 2008 crash led to $49. 2020 crash led to $30. This crash from $121 to $85. If the pattern holds, it's setting up the move to $150, $175, maybe $200. The risk reward is asymmetric. If the bears are right and we go to $70, that's another 17% downside from 85. But if the physical market reasserts and we rally back toward the highs, that's 42% upside just to get back to $120. And if we break out above that, The inflation-adjusted all-time high is $70 to $80. We just touched it. The real breakout hasn't even started yet. Here's where we are. 3 key takeaways. Number 1, COMEX silver just experienced the second worst trading day in history. $121 to $85 in 48 hours. 30% crash. $1.96 trillion in market cap vaporized. Bears targeting $70 next. But 9.4 million ounces of delivery demand and banks scrambling for physical tells a different story. This was paper manipulation, not fundamental collapse. Number 2, Shanghai Premium is $37, a 43.5% markup over COMEX after a 30% crash. In normal markets, premiums compress during liquidations. This one is expanding. Physical buyers in China paying 43% more than paper traders in New York. That divergence is proof the paper price is detached from physical reality. The crash created a buying opportunity, not a trend reversal. Number 3, 85% odds of government shutdown tomorrow. Initial reaction will be risk-off liquidation, which we're already seeing. But shutdowns force-fed accommodation and safe haven flows. Combined with record physical demand, draining inventories, and structural deficits, the rebound setup is building. Historical pattern says crashes like this set up explosive rallies. 2008, 2020, and now 2026. The unresolved tension is this. We just saw $121 to $85 in 48 hours. Do we continue down to $70 or lower as the bears predict? Or does the physical market, with its 43% premium, record delivery demand, and draining inventories, force a violent snapback that takes us back above $121 and onward to new highs? And with an 85% chance of government shutdown hitting tomorrow, does that catalyst trigger another liquidation wave? Or does it become the inflection point where safe haven demand overwhelms paper manipulation and sparks the next leg up? $121 to $85. Second worst day in history. Everyone sees the crash. But the 43% Shanghai Premium, the 9.4 million ounce delivery demand, and the historical pattern of crashes setting up rallies tell a different story. Do your own due diligence. Understand the risks. If you're trading on leverage, this volatility will destroy you. The move from $121 to $70 is entirely possible in the paper market. But if you understand what's happening in the physical market, premiums holding, demand surging, banks scrambling, then you know this crash is manipulation, not fundamentals. The question is, are you trading paper or stacking physical? Are you chasing the paper price down to $70? Or are you accumulating real metal while it's on sale? History says the crashes are the setups. The pain is the entry point. The capitulation is the bottom. This is Asian guy. COMEX destroyed silver, but the physical market is screaming the truth. Don't let them shake you out at the bottom. Invest with logic, not fear. I'll see you in the next one.